The smart money just made some big calls. The latest 13F filings just dropped, and let me warn you, this quarter is not normal, not even close, because some of the biggest, richest, most influential investors on the planet, the hedge fund titans, the billionaire whales, the secretive family offices, just made moves so extreme, so unusual, and so aggressive that the financial world is still trying to digest what it all means. We're talking major rotations out of tech, massive bets on gold and hard assets, sudden accumulation of defensive stocks, and even a few shocking new positions that no one saw coming. This is not business as usual. This is smart money panic. And today, I'm going to walk you through who bought what, who dumped what it signals about 2025, and how regular investors can prepare for what's coming next. Because make no mistake, when the smartest investors in the world all lean in the same direction, you pay attention. Why these 13F filings matter more than ever. Every quarter, hedge funds and institutions with over $100 million in assets must reveal their positions. Usually it's boring, predictable, slow adjustments. But not this time. This quarter's 13F filings reveal a level of repositioning we have not seen since 2008, and some analysts say not since the dot-com bubble. Why? Because the smart money sees what retail investors do not. 2025 is an inflection point. The U.S. economy is slowing faster than expected. Earnings forecasts are being revised down quietly. Debt markets are tightening. Commercial real estate defaults are accelerating. Geopolitical tensions are rising. And the Fed's next moves are more uncertain than ever. Institutions are preparing for a world that looks very different from 2020 to 2024. And these 13F filings tell us exactly how they're preparing. The biggest shock, massive tech dumping, this quarter's largest surprise, a coordinated reduction in mega-cap tech. Not because these companies suddenly became bad, but because smart money believes they became too expensive. Across the board, multiple funds trimmed Apple. After years of strong inflows, many major funds reduced exposure. Not a full exit, but enough to signal caution. Tesla saw major divestments. Funds aren't betting on an EV collapse. They're betting on slowing growth, margin pressure, and rising competition. Nvidia, the golden child, finally saw trimming. Not because AI is dead, but because some funds believe peak enthusiasm is already priced in. Amazon, Meta, and Alphabet also saw selective profit-taking. Funds locked in gains after an explosive 2024 rally. The message here is clear. The smart money is de-risking, hard, and they're doing it at the top. But where is that money going? The answer is shocking. Warren Buffett's moves. Warren Buffett's Berkshire Hathaway made two big signals. Major trimming of Apple. Buffett still loves Apple, but this is the biggest reduction he has made in years. And Buffett only sells for three reasons. The price is too high, something in the fundamentals changed, or he sees a storm coming. Right now, it's a mix of all three. A stealth rotation into cash and treasuries. Berkshire is now sitting on record cash, over $180 billion. Why? Buffett is preparing for a major buying opportunity, which only happens when markets fall. Translation: Buffett expects turbulence. And he's preparing to deploy cash when everyone else panics. Buffett's message? When others are greedy, I get cautious. And he is very cautious right now. Michael Burry's Big Short 2.0. Signals. Michael Burry, famous for predicting the 2008 collapse, just made moves that the media is whispering about. Burry's positions show renewed hedging against the S&P 500 and NASDAQ. Not as extreme as past years, but enough to indicate he sees risk outweighing reward. New exposure to gold miners and commodities. This is something Burry only does when he believes currencies are weakening, inflation will re-accelerate, or geopolitical risk is rising. Reducing speculative tech. He trimmed positions in small-cap tech and unprofitable companies, a classic bear signal. Burry is not calling for the end, but he is calling for a major correction. And when a man who predicted 2008, the meme stock mania, and multiple crashes makes moves like this, you pay attention. Bill Gates' new bets. Bill Gates' portfolio, managed through Cascade Investment, made interesting shifts. Increased positions in global food and agriculture, fertilizer companies, farmland, and supply chain logistics. Why? Because food inflation is not done. because global instability threatens supply, and because farmland continues to outperform most asset classes. Accumulating more renewable energy exposure, Gates is doubling down on nuclear innovation, hydrogen, and grid infrastructure. This signals a belief in long-term energy scarcity, massive government spending, and a multi-year infrastructure supercycle, quietly adding defensive stocks. Think healthcare, consumer staples, insurance. This is the classic move of someone preparing for a slowdown. The unknown giants, family offices, and secret funds. The public faces get all the attention: Buffett, Burry, Gates, but the biggest moves often come from private family offices. This quarter, major accumulation of gold ETFs, gold miners, and physical gold trusts. The biggest spike since 2011. Increased exposure to energy, especially oil producers. Not because oil is booming, but because energy security is becoming a central issue in 2025 geopolitics. Growing positions in defense contractors, Lockheed Martin, Northrop Grumman, Raytheon. War risk insurance is rising. Military spending is rising. And the smart money sees this trend continuing. Quiet buying of high-yield bonds and distressed debt. This usually happens right before corporate defaults rise, and defaults are rising, especially in commercial real estate and consumer credit. The family offices are preparing early, long before the news headlines catch up. Where the smart money is moving into. All the selling and trimming means one thing: a massive rotation is underway. Here are the top inflow categories: gold and precious metals. The biggest shift this quarter. Gold miners and ETFs had record inflows. Demand for physical gold hit new highs. Silver also saw strong accumulation. Smart money believes fiat currencies will weaken, geopolitical risk is rising, and gold is entering a new bull cycle. Energy and oil. Despite ESG pressure, the smart money is piling into oil majors, natural gas companies, liquefied natural gas exporters. Why? Because supply constraints plus geopolitical instability equals higher prices. Defense and security. Funds are positioning for war spending, drone technology, cyber defense, surveillance systems. This is not a short-term bet, it's a multi-year cycle. Utilities and consumer staples. The classic recession preparation. When the smart money goes defensive, you should take note: cash and treasuries record levels of cash. This is what happens when institutions expect cheaper prices ahead. What it all means for 2025? The 13F filings tell a very clear story. The smart money sees 2025 as a dangerous year, not the end of the world, but a year of volatility, uncertainty, and slow growth. Here are the 5 biggest interpretations. The market is overextended. Massive trimming equals they think prices are too high. Cash is king again. Record cash positions mean they expect a buying opportunity soon. Gold is entering a new age. Nearly every major fund increased gold exposure. Defensive stocks will outperform. Healthcare, utilities, staples. Preparing for slower economic activity. Geopolitical risk is now a major factor. Energy, defense, mining. These are not tech bro bets. These are real-world bets. What regular investors should consider. I'm not giving financial advice, but here's what the smart money is clearly signaling. 1. Don't chase hype. If the biggest funds are trimming tech, ask why. 2. Diversification matters again. Gold, commodities, energy. These are in focus for a reason. 3. Defensive plays protect you. Even billionaires are preparing for a slowdown. 4. Cash is not a bad position. Buffett is holding record cash, not diamond handing into the top. 5. Study what the smart money does, not what they say. Their actions speak louder than their interviews. Conclusion: the 13F filings this quarter do not point to optimism. They point to preparation. Preparation for volatility, uncertainty, geopolitical tension, and a slowing global economy. The entire mood of smart money has shifted. Quietly, carefully, deliberately. And if history is any guide, when the smartest investors on Earth move early, reduce risk, and pile into hard assets, it usually means something big is coming. Stay alert, stay educated, stay prepared. because the next 12 months will not be like the last 12 months. This has been a Felix Exposé. Stay safe, stay sharp, and as always, I'll keep you ahead of the curve. See you next time.